morning, traders. Richard here doing a quick Ichimoku cloud chart market review of the S&P 500 index, and we look at the Spider ETF, which is a replica of the S&P 500 index. Now, in the last update on the actual index, we were expecting the market to sell off in September and to correct and to form a new low in October, just looking at the seasonal patterns of the market. And now we're at a critical stage because we've got multiple cloud chart levels to look at for support. Interesting enough, the market did not find support at this top end of the cloud there. That zone there is just between 412, 413. Sold off a little bit to retest this 410 level. Now, if we look at the daily chart, we can go and see where that 110 level, 410 level comes from. You can see that top end of the cloud here. That's a whole cluster of support there. And that's very close to the bottom end of this April-May support zone there. So you can see we're back down to April-May support zone on the Spider ETF top end cloud chart. So we could see a short-term relief rally into November. November is generally seasonally stronger. And then the upside resistance target would be this low here, as well as the standard line and the turning line would be the first resistance zone for the market there at 423, and then the bottom end of the cloud into the December year-end rally. So we expect the market to rally back up to the bottom end of the cloud, and maybe test this resistance zone here above 430 on a seasonal strength basis in the market. If we now look at the 4-hour Ichimoku, you can also see where that support zone came in. You can see the bottom end of the cloud here, as well as this is a major cloud chart support zone. You can see the cloud just flatlining there. So that was a major support zone in May and June. And the market at the moment seems to be this week fighting for support, then rebounding from that zone. Upside resistance targets would be the top end, the standard line of the cloud here at 423, and then the bottom end of the cloud. So we do expect a bit of a rally into November, December to retest these old resistance levels on a seasonal basis. So November, expect the market to rally in November. This comes soon after expecting the market to sell off in September and October due to seasonal trading patterns in the market. The other levels to watch out for on the daily, it's the top end of the cloud, the bottom end of the cloud, the resistance zone, as well as this, the market needs to stay above this 410 zone. That's absolutely critical. That's a major support zone. If we dip below there, lose support there, we could easily test the bottom end of the cloud here, down here at this support zone. So that's the downside risk to the bottom end of the cloud at 399, 400 basically. So that's the downside risk on the daily if support fails at this level. But interesting enough, looks like we're completing a downward couple of downtrends. That move is almost the same as that move, and then that move. So it's kind of a retracement of a consolidation of this entire strong rally in the market. On the weekly, there's a couple of support levels to watch out for. Now, we managed to find support between this range, that old cloud chart support level, the top end of the cloud, and this old cloud chart support zone on the daily and the weekly. But there is still downside risk to this level here at, let me see that there, 405, and the bottom end of the front end of the cloud here. So these are the downside risk targets on the weekly. The upside relief rally targets are the top end of the front end of the cloud. We can see a line there. Let me just put a line in there. That's the upside resistance targets, 433, and that coincides well with the standard line and the turning line. So these are the upside resistance targets on the weekly for the November-December year-end rally on an Ichimoku cloud chart basis. Now, price actions above the cloud on the weekly, that's bullish. Now, on the daily, price action below the cloud, that's bearish, but we are looking for a seasonal trade here, swing trade back up to the bottom in the cloud. So keep in mind these are the resistance targets on the daily Ichimoku cloud, as well as the 4-hour Ichimoku cloud there. The upside potential for a swing trade is from these levels back up to the bottom end of the cloud for a resistance zone. But ideally, for a strong bull market to be in place on the 4-hour, you need to be back above the cloud, top in the cloud here, For a strong bull market to be on the daily, we need to be back above the top end of the cloud. But so far, we still expect the market to rally because on the weekly, the overall price action is still bullish, and we're getting closer to top end cloud chart support. So the front end of the cloud still not twisted to the downside. So the front end of the cloud is predicting that we still have somewhat of a bullish trend on the daily Ichimoku cloud. Just something interesting, if we overlay an artificial intelligence engine, the Fulgent AI that sits on the Metastock platform, we can see we've had a couple of really great signals in the past, but we've not yet had one on the daily. So that's kind of what we're looking for. We're looking for a major market reversal type signal or a volatility breakout on the daily. But if we go and dig in within the intraday chart, let's see if it loads. Gives a second for the AI to load the signals. There we go. We've got a quick move signal there. Ideally, I'd like to see a major market reversal, major reversal signal there. But so we have a quick move signal to the upside. That's a short-term swing trade signal. And if we go into the 3-hour AI strategy, the 3-hour chart, intraday chart frame, and then we can see we've got a volatility breakout signal here. So we've had a few really good signals, nice volatility breakout. One there worked well. If you overlay them with the cloud, you do capture some really great moves using artificial intelligence together with Ichimoku clouds to find high probability trades. Until next time, happy cloud chart trading. Bye for now.